Okay, good morning, everyone, and thank you for joining us for another session. This time we're going to talk about year-end or audit preparation. As usual, our session is tailored to First Nation communities and related organizations. However, with this year-end or audit preparation, the principles are pretty similar across the board. So if you work for a business, if you work for a profit-oriented company, you can still use the same process and the same checklist that we'll be sharing here. For the checklist, I'll be going through it in our presentation, and then we'll also distribute it to all the participants via email. Caitlin is going to send an email with a checklist in case you're interested in getting a copy. Okay, so let's talk about year-end / audit preparation. So what I'd like to focus on today is what's called the auditor's approach. So when the auditors go over our records, they use a certain approach to make it most efficient and most accurate. And when we preparing our records for the audit, really we want to meet the auditor's needs so they can verify everything in our accounting system. And so what is the auditor's approach? Well, first of all, the auditors look for efficiency, the most efficient way to confirm our records are correct. They achieve this efficiency through two main approaches. So one of them is risk-based approach. They do risk assessment for everything in our organization, and they try to find the most risky areas in our records. And so whenever there is a risky area, the likelihood of error in that area is normally higher. So when we say risky, it doesn't mean it's risky because there can be misappropriation or not good business or something like this. Risky from the audit perspective means there is a greater chance of error, a greater chance of something being inaccurate in that area. So what the auditors do is they review our records and they go, okay, which areas are the riskier areas, and we're going to spend more time in there. Now, risk is also driven by potential consequences of an error. So for instance, if, we may have a really small error in our funding, in our revenue that we show, but consequences are pretty big because the government, Indigenous Services Canada, and the rest of them are well aware of how much revenue they've flown to us, right? And we really want to make sure that our records in the audit agree to the government's records. So risk-based approach means considering consequences from a potential error and considering possibility of a potential error in an area. So another thing the auditors look at is called materiality. And what that means is basically there is a certain dollar amount that is not significant enough, that even if there is an error in that amount, it's not going to change our mind about how accurate the financial statements are. Okay, so what it means for us, if we want to take the auditor's approach and be efficient and accurate, is we're going to say, okay, maybe there is a dollar amount. Maybe it is $100, maybe it is $200, maybe it's $1,000, depending on the scope of your operations. That for us is not going to be worth spending a lot of time digging through, a tiny little thing for $200 and trying to match it to the penny. Okay, so when we work on the year-end preparation, it's really helpful to take this approach because it's a big picture approach. So first of all, we look at our financial statements, we look at our records, and we ask ourselves, okay, where are my biggest risks? Okay, and maybe I have a certain department that's been struggling with their records. Maybe I have young and inexperienced staff somewhere that are more likely to make errors. Maybe I have a history of messy records somewhere, right? So all these factors are risky. So if I know, for instance, that my education department, they haven't been doing so well with maintaining records, now they're a risk area for a year-end preparation. So I want to spend more time looking through education records as opposed to other departments that may be doing much better. Okay. So another principle that's very important for year-end preparation is what's called matching principle. So what that means is all revenue and expenses that belong to our year-end need to be recorded in the year-end. So that makes sense, right? Whatever belongs to the period should go in the period. However, when you think about it, many times it gets missed. Because, for instance, say we're March 31st year-end and we have funding that got approved and belongs to the year-end, but it didn't come through, didn't get deposited into our bank account until April or May, right? So unless we catch that and record a receivable for that funding in our year-end, it really isn't going to get recorded until when it's received, until April or May. And that's not following the matching principle. That's not good for a year-end or an audit. Okay, another example is we may have vendors that send their bills much later, much after the year end. Sometimes we have vendors who just not diligent and they don't send the bill until we ask for it, right? Lawyers can be very slow with sending their bills. So at March 31st, we may still have some bills out there with vendors, maybe with our program managers, that belong to March 31st. But they're not recorded in the system because we in accounting haven't seen the bills yet. We haven't received them. So when we do the year end, it's really important to work with that matching principle and ask ourselves, is our revenue complete? All revenue, all funding belongs to the year end. Is it recorded in the year end? And are our costs complete as well? Are all the costs that belong to the year end recorded in the year end? Okay, so then another thing we can learn from the auditors, and we use it a lot in year-end preparation, is balance sheet approach. Most of you know that we have two main financial statements. We have the income statement, profit and loss, statement of operations, where our revenue and expenses and surplus to deficit are presented. And then we have our balance sheet that really is a statement of net worth. So we have our assets, everything we own, and our debt, everything we owe. The difference between the two is our net worth, and that's presented on the balance sheet, which is also referred to as statement of financial position for nonprofits and First Nations. And so balance sheet shows account balances at a specific point of time. So here in my example, it's March 31st, 2022. That's my year end, for an example. So if we were to try and confirm every balance on the income statement, they consist of many transactions, right? So if I look at my expenses, say my travel expenses, if I were to try to confirm that my total is accurate, I would have to go through every invoice, through every check requisition, through every payment that's in travel expenses. And I may have hundreds of entries in there, right? Because some of our organizations do a lot of travel. So that's very inefficient if we go through income and expenses to confirm the accuracy of our records. Now, as opposed to this, balance sheet shows balances on a certain date. So say I have cash in the bank, that would be the balance as of March 31st, 2022. And to confirm that balance is actually quite easy. So to confirm the balance of cash in the bank, all I have to do is do a bank reconciliation, right? So reconcile my bank to a bank statement. If I have an investment in the markets or GIC investment, it's easy to confirm the balance as of March 31st. All I have to do is just compare the balance in the books to the statement from the investment manager or from the bank, right, for a GIC. So, and the balance sheet approach is efficient because if my balance sheet is correct, if I addressed all the balances, all those receivables, payables, assets, and debt, then my income statement is also correct. Just because the balance sheet and income statements are interlinked, right? When we went through our double entry accounting and financial statements, we spoke about how those two are interlinked. So we make sure our balance sheet is correct. That makes sure all of our records are correct, okay? So when the auditors do the audit, or when we prepare for year-end, the most efficient approach is to go through every balance on the balance sheet and make sure it's accurate by comparing it to some sort of a third-party document, such as a bank statement for a bank, a credit card statement for a credit card, and we'll go through the list of what we can do to confirm those balances. So I'm just reading the last paragraph here. If my opening and closing balance sheets are correct, my income statement is correct. And that's the most efficient way for making sure our records are correct. So it may not be what we're used to, but this really is the proper way to prepare for year-end, where we bring up our balance sheet in the accounting system and we go through every single balance on a balance sheet and confirm that it's correct. So we talked about risk assessment, right? And in a risk assessment, like, it's needed so we can allocate our efforts accordingly. So if something is risky and it's really important, we want to spend more time on it. If something is risky but not so important, maybe we spend less time on it. If something is completely not risky, like for instance, if we know our payroll is recorded really well because the person that's been working on it's been there for a long time and they know what they're doing, maybe we don't spend that much time worrying about payroll accuracy, right? And so in the risk, we look at big picture risk, so finding drawbacks and intervention, and big picture risk always overrides other considerations. So why do I bring it up? Sometimes when we work on year-end preparation, we get caught up in many small details. Okay, this account isn't reconciled, that account isn't reconciled, and each one of them individually may not be super important, but of course we like to have everything reconciled and correct. We work in accounts and in finance, and it's our nature to make sure everything is correct. But what's happening in the meanwhile, our audit is being delayed, right? And then when our audit is delayed, we can have funding halts, right? And if we don't submit our audit for many years, which hopefully doesn't happen, but may happen, then we go into risk of intervention, right? Where the government may say your financial management isn't good, and we're going to force some help on you. So the point here is big risk, like big picture risk, should always override small picture risk. So if I have a few accounts that I'm struggling to reconcile, I'm struggling to confirm, maybe it's okay to let go of those accounts and send the records to the auditors for the sake of making sure the audit is done on time. And if there is a big issue with some of those accounts, the auditors will let us know, okay? And now the small picture risk is what we spoke about, certain areas of our records of our organization where we're most likely to have errors, could be allocations to different programs, could be bills received after the year end that belong to the year end and are not necessarily recorded in the right period, could be inexperienced staff making errors. And each one of you knows your organization from inside really well, and you can probably assess those risks even way better than the auditors. So we spoke about materiality, how it is important to just not focus on tiny or smaller amounts. Sometimes we're not reconciled somewhere within a couple of $100. Maybe it's okay to let go if the big picture is we have to get that year-end done. Okay. Then we also want to consider cost-benefit approach. If it's going to take me 3 hours to find a $10 error, maybe it's really not worth my time. So we talked about the matching principle. This one is reiterating again that this is the most basic accounting law. We need to make sure all the revenue and expenses belonging to the year need to be recorded in the year. And let's go straight into our audit preparation checklist. So this checklist can be used anytime you're preparing for a year end or even for quarter end. It's mostly tailored to preparing for an audit. But again, if you're just working on a quarter end, lots of the same steps and processes will apply. So we need to make sure our open and retained earnings agree to last year's audit. So that accumulated surplus that was shown in our records from all the previous years, it should match the accumulated surplus in the audit, last audit completed. What that means is that all the year-end adjustments were made. Okay, we're going to have a separate session on this. It can get a little technical. But if this is too technical at this point, then all you have to make sure is that all the auditor's adjustments from last year were made in our system. Whoever is responsible for it, we can ask them for the adjustments made. Okay, now why is this important? Well, remember we're taking the balance sheet approach, so we want to make sure the opening numbers, the numbers we start with in our system, are correct. And they're correct if they agree exactly to last year's audit. Next step is to reconcile all our bank accounts, including bank loans. So when we prepare a bank reconciliation, we have a session on it. So hopefully most of you are familiar with the process. We have a report produced from our system that shows the balance in our records versus the balance in the bank and explains the difference. Now, in that explaining the difference, we may have some outstanding checks. So outstanding checks are checks that we've issued on our end, but they haven't cleared the bank yet. Maybe they're still in the mail. Maybe our vendors are too slow to cash them, right? But they're sitting in our records and they're showing on the bank reconciliation as a reduction from the bank balance. So what happens very often is if we don't review that list on a regular basis, it can have some transactions that are no longer relevant. So for instance, I issued a check, somebody lost it, then I issued a new check. But it could happen that I forgot to cancel the previous check and it's still sitting on my bank reconciliation. Or I issued a check and, and somebody never contacted us and it's been half a year and we're not sure what's going to happen, but likely they're not going to cash it, right? So maybe that shouldn't be sitting on my bank reconciliation either. It's very important we go through that list and we clean it up. So any old items, excuse me. Okay. So any old items that are affecting our bank balance, any items that we know for sure aren't going to clear, aren't going to be cashed, they need to go away. They shouldn't stay on our bank reconciliation. So if we don't do this step, the auditors will do it for us. So we're not saving any time, because when the auditors do it, they'll come back to us and they'll say, hey, you know, this check has been here for a year. Do you think it's ever going to get cashed, right? So we're still going to put the time into it, except the auditors are going to make the adjustment. They will charge us for the adjustment, and then we'll have to make it in our system, which sometimes can be tricky because it's after the fact and it's affecting your bank. So it's very important we clean up the bank before sending it to the auditors. Reconcile all credit cards. So credit cards are effectively just like our bank. It's a method of paying, right? So same thing, we have to prepare reconciliations. We need to make sure that there are no old outstanding items. It doesn't seem to happen very often on a credit card, just because it's different in our bank. It's not as complicated, but still definitely take a look at your bank reconciliation and make sure any items that shouldn't be on there as outstanding are gone from there. Now we're on to accounts receivable. So everything owed to us from funders, from customers. So for accounts receivable, we want to review an aged receivables listing. We went through this in our revenue and accounts receivable session. So that listing shows us amount owed by customer and the aging of the amount. So how old it is. Is it just 30 days, 60 days, or is it really old and over 90 days? So first thing we'll do is we'll make sure that the total of the receivable listing agrees to the receivable balance in the GL on our balance sheet, because in some systems, what can happen is we can post into the receivable subsystem, but not update the GL. And then a difference could be created between our receivable subsystem balance and then GL balance. The problem with that difference is now we can't really support the GL balance, and the auditors will question it. And again, it will cause more work for us and more work for them. So make sure your aged AR agree to GL. Now, another thing to do is any receivables that are old, anything over 90 days, review them for collectability. Are we going to collect them, or are they just sitting there for nothing, right? And if they're not collectible, we should write them off. Next thing for accounts receivable, remember the margin principle. So is all revenue that belongs to the year end recorded in the year end? So when you review that list, ask yourself, am I missing something? Is there funding that belongs to this year that's coming after the year end that I have recorded here? Is there a sale we made, maybe in a bank-owned business, that hasn't got recorded for whatever reason in the year end, because maybe related invoicing? So this is what we want to be to pay attention to, receivables. Next item, and you'll see this list is in the same order as our balance sheet. So next item is employee advances receivable. So if we give employee advances, then we do need to do work on the amount receivable from employees at year end. The best process is to actually have a rule that all employee advances need to be repaid prior to the year end, and then you don't have to worry about that balance and, you know, go through additional work. If we do have a balance receivable from employees, we have to go through the GL, we have to go through the detailed listing for those employee advances and prepare a list showing how much is owed from every employee. So say if I have $10,000 in employee advances receivable, I need to be able to produce a list showing employee A owes us $5,000, employee B $3,000, and so on until I arrive to the total of that $10,000. Next item is prepaid expenses. So prepaid expenses is more of an accounting exercise, and if you're not familiar with the concept, that's fine. Normally auditors take care of it. What they need for it is copies of our insurance invoices and insurance policies. So as long as we provide it to the auditors, we've done our work here for prepaid expenses. Now on to accounts payable. So accounts payable, we do similar work to accounts receivable. We print out accounts payable aged listing, aged report, which shows a balance for every vendor with aging, and then the total at the bottom. So again, the total of the aged accounts payable listing needs to agree to the total in our GL on our balance sheet. For some more complex systems like Sage 300, it's possible that the two won't agree. It's possible that we're making entries directly into the payables subledger and we're not reflecting them in the general ledger or vice versa. And then when that happens, we have an issue. We can't support our balance on the balance sheet, the payables balance. And so we need to make sure the subledger agrees to the general ledger, or the list agrees to the main balance on the balance sheet. So again, with payables, we want to review the amounts that are old. Anything over 90 days, we want to kind of take a look at, maybe discuss with people that are responsible and see if they're still payable and why they're still there, right? Sometimes we can show significant credits from vendors. So we may want to question those as well, because especially if they're old. Sometimes what happens, we make a payment to a vendor and we just don't apply it correctly because we're busy with different things and maybe our staff isn't experienced. So by reviewing that aged payables list, and it gives us an opportunity to clean up those accounts. And the idea is for every vendor, we want to show exactly what's owed to them at the year end. Sometimes with payables, we're not quite sure what's owed to different vendors, right? And this is, if the amounts are significant, this could be a good time to reach out to the vendor and ask them for a statement with a balance at the year end, so we can compare what's in our records to their records and then reconcile whatever doesn't work. Now, with accounts payable, this is where we get again into the famous matching principle. There is a very high risk for every one of our organizations that some bills that belong to the year end didn't get recorded in the year end just because they got received after the year end. So when we do the work on accounts payable at year end, it's very important to review payments and bills after the year end and review them for dates and for when work was done. And if some of them belong to the year end, this is where we bring them into our year. Okay, next item on the list is our interdepartmental loans or intercompany loans. So for most of our organizations, there is going to be more than one department, or maybe many departments, like for First Nations, right? And we have education, health, economic development, band programs, on-source revenue, and so on and so forth. Those departments may be run by different people, and they may have separate budgets and separate operations. But what happens, sometimes we borrow from one department, we lend money to another, and we create intercompany or interdepartmental accounts receivable and payable, loans and advances. So what's really important for the year end is that those accounts are reconciled. So if I'm looking at education records, and education records show that the band owes education $100,000, I better see on the band records a payable of $100,000, right? Because what could happen otherwise? Education lends $100,000 to the band. The band accountant isn't aware what happened. They just see money coming into the bank account. So instead of recording that $100,000 as a payable to education, they can record it as revenue, right? They can record it as a surplus for the band, which is completely incorrect. So to prevent those errors, we need to make sure those interdepartmental loans are reconciled. So whatever one department is showing as a loan should be reflected in another department in the same amount. Next item is payroll accrual. So with payroll, it never falls right at the year end. We all know it. There is always some sort of cutoff issues. So sometimes my first payroll in April includes a number of days that belong to March, right? And remember, this is the matching principle. It says if some of April payroll belongs to March, it should be recorded in March. So for payroll accrual, it's a technical process. Basically, we take the amount of payroll from April, from the first pay in April that belongs to March, and post it as payroll accrual in March. If you're not familiar with that process, just provide the last payroll report for the year and the first payroll report for next year to the auditors, and they'll calculate the payroll accrual and do it for you. It's a quick process. This is not increasing your audit cost substantially. Next item here is repairs and maintenance expenses. So remember, when we have costs, when we spend money on our programs and activities and operations, some of those costs may be considered capital, they may be considered assets. So if I bought a vehicle for, say, $50,000, because it's going to serve the program for longer than 1 year, most likely I'll record it as a capital asset as opposed to an expense, right? So repairs and maintenance expenses tend to have some of those capital items posted in there, and it's important to review repairs and maintenance for larger items. So if we did a major renovation to a building, we spent $200,000, yes, it can be viewed as repairs and maintenance, but maybe it is a capital item and needs to be shown as an asset as opposed to an expense. Now, this is where a confusion happens in First Nations sometimes, because really, say, I got money from the government for major renovation of a building, right? So from accounting perspective, if I receive $200,000 on a major renovation, I have to call it an asset. It's not an expense. It's not reducing my surplus. It's an asset because the building is going to serve me for the next 20 years, right? So I can't expense all of it in 1 year. Now, from ISC perspective, though, they want to see funds and revenue of $200,000 minus expenses, the costs of $200,000. You want to see that we spent it all, right? So how do we achieve it? If you remember in our last webinar about audit, there are two sets of statements, two main sets of statements. One is our main audit, and that main audit has to follow the accounting principle. So within the accounting principles, it will require that the $200,000 renovation is shown as an asset on the balance sheet because it's going to serve our organization for years. It's not just this year's expense. And that's what we're going to do. On the main audit, the auditors will show this as an asset. Now then, the second set of financial statements is our audit schedules. This is where we have an income statement with revenue and expenses and surplus or deficit for every program. So those audit schedules would have a separate schedule for building renovations that would show funding of $200,000 and repairs and maintenance expense of $200,000, zero surplus or deficit. So those audit schedules, they're not a part of your the main annual audit, and they don't have to follow the strict accounting rules. So they will show the government what the government wants to see, but for the purposes of the main audit, major spending on asset needs to be at least brought up to the auditor's attention as potential assets, not expenses. Okay, so the next item here, review transactions in capital assets. So those are my major assets. So any additions to capital assets, we want to review smaller items. So sometimes, you know, somebody bought shares for $200 and then it got put into an asset account. So on my balance sheet instead of an expense. Well, that may be an overkill. We really don't want to keep, because anything we put in assets is going to stay there forever, right? It's going to get amortized every year, but it's going to stay in the asset account as our asset for years. So do we really want to keep track of a $200 share purchase? Maybe not. So my rule of thumb is always anything under $1,000 expense, anything over $1,000 consider, right? Consider for putting into an asset based on scope of your operations. So for any major capital asset purchases, say anything over $25,000 for sure, you need to provide copies of invoices to the auditors. And normally the auditors will send you an information request and they would indicate what amount over you have to provide those invoices. So now we're on to revenue. So remember that our funders may not necessarily know much about our operating costs and expenses, but what they know for sure really well is how much funding they flow to us. Making sure that our revenue, the funding received in the year end, in the audit, matches what the government records show is really, really important. To give you an example, we had an audit issued and one of the programs was out by $96. The funding received, we showed $96 less than what the government records showed. So they came back to us and requested we revise the audit for $96. So this is technically one of the most important areas of your year-end preparation. Now, what happens is your funding services officer, FSO at ISC, would send a year-end confirmation reports that show all the funding that was flown to your organization, and you can use those reports to agree what's in your system to what's in the government records. Now, if you don't get those reports, definitely establish a relationship with the FSO or whoever the funding officer is for CMHC or maybe Health Canada, and start getting those reports so you can reconcile the revenue. Review income statements versus budgets and last year. So in our records, we normally have departmental statements. So every program would have a separate income statement, right? Funding received and all the expenses. So it's good to review those departmental statements, actually all our income statements versus the budget, versus our expectations, and versus last year. And if there are significant differences, maybe we want to question what happened. Are we missing something? Maybe we're missing some revenue, or maybe we're missing some expenses. When we say review those income statements, maybe us in accountants aren't the best candidates for review in certain departments because we don't necessarily know what's going on in health, for instance, right? So what we like doing is asking the managers for different programs to review statements for their programs and confirm to us that they look good to them. Because what could happen if we don't involve the managers is we finalize the audit, there is a surplus in a certain program, and then the program manager gets a letter from the government saying, by the way, you have a $150,000 surplus carrying over and you have to repay part of it or spend it next year. And then they go, wait a moment, I don't have a surplus. You missing expenses. I haven't told you about this, this, and that, right? So in accounts and in finance, we really don't want the responsibility for program surplus, carryover, and repayment. Anytime we issue a statement, a financial statement, we want the program managers to review it and take responsibility. So for me, the process is before I even send records to the auditors, I get every program manager copies of their financial statements. I get them to review and let me know that they're okay with the amounts. Now, some of them are seasoned and they really know what they're doing. Some of them are newer, maybe not so strong financially. In that case, I would sit down with that person and explain to them, okay, see, in this program, you have a surplus. And it shows that the surplus has to be repaid if we don't spend it all by the end of the year. Are there any expenses we can allocate to this program to reduce the surplus, right? And so on. So if they need help, we help them, because that's our role, is to support programs and program managers and leadership with financial information. Now, review transactions in the detailed revenue and expenses GL. So that's a listing of transactions by account, right? Again, this review may not be relevant for you as the finance person, because you don't necessarily know all the operations. Again, this is where it's good to involve program managers. And you don't necessarily have to spend significant time on it. Is just to skim those accounts and to see if anything looks out of place, if anything looks funny and doesn't belong in there. Review transactions in miscellaneous, ask my accountant, and other questionable accounts. So in general, it's good to not have any transactions, any balances in those accounts, like miscellaneous, ask my accountant, reconciliation differences. And reconciliation differences, you can have some, right? If it's under whatever, if it's a couple of $100, it's probably not a big deal. But if all of a sudden we're showing $20,000 in reconciliation differences, we definitely want to review what's there, because it will be questioned by the auditors. And we're not saving ourselves any time by leaving it to the auditors, because they'll come back to us to figure that out. If you do have miscellaneous expenses in your GL, sometimes it's a really good idea to just deactivate that account, because nothing should be in miscellaneous. Really, when you think about it, there is enough categories that you can use one of those to allocate to. Miscellaneous is always considered a risky area. It will be reviewed by the auditors. The government don't like it either, because why would you call something miscellaneous? It's either program supplies, office supplies, travel, wages, whatever. You can always allocate something. So try to stay away from miscellaneous. So again, departmental income statement reports to make sure program allocations are proper, right? And this is where we want to involve program managers. Professional, in particular legal fees account. So this is where the auditors want to see copies of all the invoices and all the correspondence with the lawyers, just because they're looking for potential lawsuits. So they'll review 100% of your transactions in the legal account. It's just good to be ready for it. Then here's the list of reports to provide to the auditors. So they want to see a trial balance, balance sheet, income statement, total and by class of departmental, detailed general ledger, and copies of budgets and budget versus actual reports. Now, most auditors nowadays prefer it in electronic format. So if you send it as an email, it's probably much appreciated by the auditors. Next thing is, if your organization maintains minutes of meetings of board of directors, finance committee, chief and council, the auditors want copies of those minutes. Again, they're trying to understand the risks and the operations of our organization, and those minutes may contain important information, and they want those minutes since the beginning of the year up to the date of the audit work. Okay, so if they're doing the audit work 3 months after the year end, we have to provide the minutes up to 3 months after the year end. Provide copies of all bank and credit card statements after the year end until the date of the audit work to the auditors. So remember the matching principle. So all our expenses and revenue for the year end needs to be in the year end. The way the auditors test it is they ask for your bank and credit card statements since the year end to date, and they review them and test larger transactions to see if any of those transactions belong to the year end. That is a mandatory step for every audit. And this step takes time, right? Because they have to go through a number of transactions on your bank after the year end and test them, see the support, make sure it doesn't belong to the year end, and if it does, and it's recorded in the year end. If our audit is late, say normally I do my audit 3 months after the year end, then the auditors only have to review 3 months worth of the bank statements. Now, if I'm late and my audit is being done 9 months after the year end, now the auditors have to review 9 months worth of bank statements and test them. And it's not only an increased cost of the audit, it's also increased hassle to us because we have to provide all this information. They don't just go away, right? Now, for some of us, the audits may be very late, especially from COVID. I know many First Nations got behind. So if the audit is 2 years after the fact, you have to provide 2 years worth of those bank statements. The later the audit is done, the more it costs and the more hassle it is. I'm sure we all know it, but this is just to illustrate the same thing. Any lease agreements, office photocopiers, equipment, the auditors want copies of those lease agreements, and this is because they put a note in the financial statements about financial commitments that the organization has. And that's it. Thank you for your time.